Hey guys, welcome back today for another episode of Things You Should Know Accounting Edition. Today we will be talking about the balance sheet, the third and final portion of a standard set of financials. A balance sheet is a snapshot at a single point in time of the company's financial position. It details the assets and liabilities of the company on that day. Unlike the other two financial statements that cover a period of time, this is just at that day. The balance sheet shows assets, liabilities, and owner's equity, much like the equation we first learned about. Of course, the assets are the amount and types of property owned by the company, ranging from cash to land and investments. Liabilities are how much debt the company has incurred and how much it owes the creditor. The owner's equity shows the value of the owner's equity as of that date. To prepare the balance sheet, you'll need to do the following. Now let's refer back to the balance sheet, guys. So this is the first thing you'll need to do. You need to have the 3-line header. The first is the who, Jello's Coffee Shop, of course. The second line is the what. In this case, it's the balance sheet. And the third line is the when, January 31st, 2014. Once again, I reiterate, this is the actual date of the balance sheet, not January 29th through the 31st, not January 1st through the 31st, but just on January 31st, 2014. To prepare the balance sheet, you need to do the following thing. For business purposes, the assets and liabilities are used in what is called an account form. They are parallel to each other, with the total assets and total liabilities / owner's equity sharing the same row. So basically you'll have one set of columns for assets, a parallel set of columns for liabilities, like you see here. So you'd have the 1 and then 1. You want to have the total assets and total liabilities match up. The second aspect you should know, if this is on column paper, lined columns like the old school paper, you would not have the dollar signs. Otherwise, the dollar sign begins at the first item in that column, and also on the total, on any totals that you do. So like the first line of the assets and liabilities would indicate the dollar, and then your total assets and total liabilities would also have the dollars. Also remember, we still use the single line to indicate that all these need to either be added or subtracted together. Now, another thing about formatting of a balance sheet, you'll take all the assets and all the liabilities and owner's equity. You want to put the assets in order of liquidity. What this means is you want to put it in order of assets that are easiest to spend. In this case, it's always cash, and a lot of times they have what's called cash and cash equivalents, which are quick to trade stocks, are listed first. Accounts receivable are usually considered to be sellable within 30 days, so they'd be next. Supplies, a little not as quick as accounts receivable, but still can be liquidated fairly quick. Equipment would be the last, because those are the things that you'd have to put out for sale and hope to get some money back. So that's how the order of these they should be in. Unlike the other statements that follow how it's listed in the account, in the chart of accounts. Liabilities is in a similar way, but in this case it would be in order of debts that need to be paid. So the shortest to longest term debts. If we were to have, let's say, accounts payable, which is paid in 30 days, you usually put that first. Loans under a year, then loans over a year, so on and so forth. There are some debts that are long-term debts that you bought a building and you have 30 years of payments. Those usually are on the bottom. And then, of course, below that you'd have the owner's equity, which is a separate section, and you list out, in this case it'd be Jello's Capital. Now the reason why I list it like this is if in the future someone else decides to invest with Jello, you would insert them under Jello and they'd have their own set of equity because you track it separately. Now, you would take all these numbers. These numbers should come from your account, your chart of accounts. If we go back, you'll see we have cash is $109,000, accounts receivable $10,000, equipment $22,000, supplies are $5,000. So if we go back to the balance sheet, cash is $109,000, accounts receivable $10,000, supplies $5,000, equipment $22,000. That's how you come up with your money. For the liabilities, you'd find the loan in this case. You go back and you'd find the loan here, $17,000. And then, now this is why you need to have things done in the order we've done. You get the owner's equity here, $129,000, from the statement of owner's equity that we did last time, which if we zoom it in, last time we did the statement of owner's equity, $129,000. This number directly goes over to here. And that's why it's important to do it in that order. Now, a final check to make sure you got everything is your total assets should equal your total liabilities. You'll add all these together. That single line indicates everything gets added together. which is $146,000. And on the liability side, you add all those together. That also equals $146,000. That's how you know that these are correct. So once again, always double check that your assets equal your liability and owner's equity. Well, that's it, guys. That's our third statement, financial statement, the balance sheet. This wraps up all of our financial statements. Next week, we're going to do T accounts. Not my favorite subject, but we're going to get through this, guys. I swear it. Till then, I'll talk to you later. Take care.